Countdown: top investment options for maximizing your returns. Investing money is an effective way to grow your wealth over time. However, with so many investment options available, it can be challenging to determine where to invest for the best returns. It is important to consider factors such as risk tolerance, investment goals, and time horizon before making any investment decisions. That's why in this video, we will explore some of the best investment options available and provide insights into how to invest your money wisely. We will answer a Facebook query about this topic. So stay tuned. Click the like and subscribe buttons. Let's begin. Frederick is 68 and debt-free, but where should he invest $250,000? It's an excellent question because the market has been all return and little risk lately. Not always. Any 10 or 20-year market era has peaks and crashes. Series I bonds, the market's best-kept secret, are number 7 on the list. Financial advisors won't mention these because they don't get commissions. The finest risk-free return you'll ever earn is through treasurydirect.gov's free investments. As the government can issue additional money, the 10-year treasury bond is considered risk-free. The 10-year yields 1.5%, less than inflation. Here's a better one. This risk-free investment earns twice that return and provides a tax advantage. In 1998, the Series I savings bond helped small investors beat inflation. I bonds presently pay 3.54%, which is the highest since 2011 and will rise when inflation rises. TreasuryDirect.gov lets you invest $25 in 30-year I bonds for free. That's a 30-year return with inflation protection. If you sell I bonds within 5 years, you lose 3 months of interest, but that's a small charge. The average savings account pays 0.04%. This gives your emergency funds risk-free security and 88 times the interest rate. Our sixth investment option doubles your money. BlockFi, a Bitcoin network, lets you make over 8% on your investment and keep it safe. Bitcoin and Ethereum receive interest, but USDC, GUSD, and PAX coins earn 8.6%. Stable coins because they track the dollar. The USD coin, backed by dollars, is worth $1. Hence, that digital token maintains its value. Digital savings account. Depositing money into a BlockFi account converts it into stablecoins, which is like having a savings account with a rate more than 200 times that of a bank. BlockFi may charge higher rates because it lends stablecoins from its vault, and institutions, investment managers, and money managers need liquidity. That 8.6% interest rate isn't risk-free. These stablecoins track the dollar, however the account isn't FDIC insured. BlockFis are not banks but regulated by the New York Department of Financial Services. Like any savings account, you can withdraw your money anytime. BlockFi charges $10 each withdrawal after one free withdrawal per month. I'll give a link in the video description to learn more as it's new to most folks. Here we're investing in risky options. Preferred shares are beneficial for stock dividends at number 5. Preferred stocks have specific rights. Preferred shares have a fixed dividend yield and must be paid before regular owners receive dividends. Some investments also pay bigger dividends. Bank of America's preferred shares pay 6 to 7% dividends, while its common stock pays 3%. Preferred shareholders are paid before common stockholders but after creditors in a bankruptcy. Best of all, preferred shares have some of the growth benefits of normal equities, and most are convertible into regular stock if the share price rises enough. The corporation is basically saying enjoy this greater dividend yield if the stock price stays flat and perhaps better gains if it rises. Like bonds and equities, you can acquire preferred shares on any investing site, but the ideal way is through funds that own a portfolio of them. Preferred shares of hundreds of firms provide rapid diversification and better dividend payouts. The iShares Preferred and Income Securities ETF, PFF, has a 4.6% dividend yield and a 6% annual return. My favorite asset class, real estate, is next on our list. Everyone knows I adore real estate investing. I became a commercial property analyst there. My rentals have generated the most long-term wealth. Bankrate found that Americans invest most in real estate. We discussed real estate equities on the channel, but property platforms like Fundrise and Streetwise are another option. I appreciate these alternatives because they offer significant real estate returns without the large down payment required to acquire property directly. These professionally managed funds own properties and pay dividends like REITs. They aren't publicly traded and hold fewer properties. Since late 2019, I've used Fundrise. $84 in dividends and $85 in appreciation from $1,000. I earn 10.7% annually. I enjoy Fundrise honesty. All properties are updated. The platform shows debt and equity investments. Click here for a complete description of each property, including market analysis and financials. These smaller property portfolios allow managers to focus on the best profits. My Fundrise account tops most of my REITs with that double-digit return. Fundrise offers property portfolios that focus on dividends or price appreciation. The platform's 90-day guarantee scheme is new. Start with $500. Fundrise offers a 90-day refund if you don't like it. It's a terrific method to start a real estate portfolio risk-free. We still have 3 more investments and that specific strategy to showcase. Third, property tax liens offer a better return and lower risk than real estate. Tax liens are my favorite passive income source and high-return investment. Homeowners realize that the county taxes all district properties. If such taxes aren't paid, the property is liened and can't be sold until they're paid. The county will auction the lien to an investor to fix the pothole on Elm. Over time, the investor collects the lien amount and interest. They are great because the county collects back taxes and sends the investor the lien amount. You might buy that property for cheap if the lien isn't paid. 29 states sell tax liens, some sell deeds, and some offer both. Liens are the safest investment, so we'll examine them. Tax liens can be purchased by non-residents. I'm from Iowa, and I used to buy tax liens in Cook County, Chicago, Fulton, and Georgia. Currently, you receive interest on liens from 10% to 36% in some areas, and owners have 4 years to redeem them. You can lock in that interest rate for years. Tax liens vary by county. Whenever a property owner falls behind on taxes, the county puts a lien on the property and lists it for the yearly auction. Register for these auctions and get a list of properties months in advance. Plan ahead. Tax lien investing offers substantial returns. Certain liens yielded 24%. Since 90% of these things are paid off by homeowners or banks, it's practically 100% passive. But it takes time to investigate, and you may have to go to other counties or states to discover enough properties to invest all your money. You'll need to pay taxes on these $1,000 liens. Value stocks follow 2 high-return investments before that specific technique. Value equities give that potential return but are lower risk than growth or tech stocks. Value stocks have lower PE or PS ratios. It's discounted company stocks. Most investors overlook that last aspect. Tech stocks are value stocks, just like financials and healthcare stocks. Nonetheless, compare stocks in the same industry. Facebook's 30 times PE seems costly compared to Bank of America's 17 times PE. But, compared to Google parent Alphabet's 33 times price-to-earnings ratio or Amazon's 65 times, Facebook is the bargain play in its industry. So, you can invest in tech stocks and value stocks. Value has outperformed growth over the long term. During 80 years, value equities have outperformed growth by 4.5%. Just comparing 2 figures yields value stocks. Yahoo Finance or any investment tool lets you search for price-to-earnings, sales, or book values and compare stocks across industries to get the best buys. Penny stocks with an annualized 27% return are our top investment. Penny stocks are small, fast-growing enterprises that could become the next Tesla, $660 million market cap, or Apple, $2.2 trillion. Penny stocks provide the chance to invest in the next big thing before it becomes a $2 trillion Apple firm or Netflix's 4,000% return over the last decade. Penny stocks thrill investors and help small companies develop. Penny stocks have drawbacks. The first is volatility, even on excellent gains over the last year. 7 of the 17 penny stocks we've advised on the channel are in the red by as much as 18 and 23, and this was the core of my job as a venture capital analyst, discovering small pre-IPO companies or new penny stocks, going into their financial statements, and recommending the best. Yet extra labor pays off. Venture capital and angel portfolios earn 27% annual returns, roughly 3 times the market average. Over the past decade, the Vanguard Small Cap Growth Fund outperformed the S&P 500 by almost 43%. Penny stocks are rich. Such small cap fund outperformance would turn $200 a month into $187,000 over 20 years, $80 grand more than investing in the wider stock market. Penny stocks, the tiniest small-cap companies, may develop a portfolio to over $1 million in that period. Our channel has many outstanding penny stock videos, but any investment app can screen for them. For tiny company flexibility, start with equities under $500 million market cap. For faster growth, I look for companies with at least 20% sales growth and a robust balance sheet with more cash than debt. Small-cap enterprises require cash stability to survive. Alright, that was a lot to take in, and I see some eyes glazing over, but don't feel like you have to invest in just one of these. Combining a few of these is the greatest method for maximizing return and minimizing risk. Find your risk tolerance. Use it and the 2 or 3 assets surrounding it to develop a portfolio that will provide you a fantastic return and smooth out the risks in each investment. This works because numerous investments react differently to the economy and don't increase or fall together. While some of these will rise while others decline, investing in 3 or 4 will level out your money's ups and downs. It reduces risk while maintaining profit. If you like this video, don't forget to share, hit the like button and subscribe because we'll be giving you more videos like this. Click that video on your right. Thanks for watching, and see you at the next one.